Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of IDFC First Bank hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Kunal Shah from ICICI Securities. Thank you and over to you, Mr. Shah.
Thank you and good evening everyone present on the call. Today we have with us Mr. V. Vaidyanathan, Managing Director and CEO. Mr. Sudhanshu Jain, CFO and Head Corporate Center, and Mr. Saptarshi Bapari, Head Investor Relations from IDFC First Bank to discuss their Q3 and 9 months FY22 earnings. Congratulations for a good set of numbers and over to you, sir.
Thank you. Good evening, everyone. It's really a good pleasure to talk to all of you this evening. I'd like to just say that we had a good quarter and we thank all of you for your goodwill. I'd like to just give you a quick brief about how the last few years have been, and then I'll come to the particular quarter. Now, it's been exactly 3 years since the merger, so 3 years is a good round number. So I thought I'll just tell you quickly 3 years how much distance we've covered. We've tripled the number of bank branches from 206 to 599. We've grown the ATMs 6x or a little more than 6x from 112 to 727. The CASA as such has grown from only 5,274 crores at the time of merger to 47,000 crores. So that's a growth of 42,000 crores in 3 years. I think by any standards, that's a good number. The CASA ratio increased to 51.6%. We dropped rates a few quarters ago and, still stable at 50% plus. So that gives us a lot of confidence. The core deposits, what we call the core CASA, retail CASA and retail term deposit, that's grown by 54,000 crores in 3 years. So the short point out of these 5 data points to you is that I think now it is beyond doubt that our bank is able to raise very significant amount of retail deposits from the market, from the public, and that comes from a good product, good pricing, good brand, very customer-first philosophy, very service-centered philosophy, and so on. So I think all of these factors have played a big role, and therefore now we feel very confident that really if the bank starts growing again at 20-25% per annum from here on, which we believe we will, the kind of deposits we will need will be about 20-25,000 crores a year. But since we've done that, we just feel that we'll be able to do that comfortably now. Now, the second part of the work we've done over the last 2-3 years is that we have substantially brought down, the infrastructure loans. The infrastructure loans have come down from 22,000 crores at the time of merger to just about 8,000 crores now. So I think that's a big drop. And later in the conversation, I'll try to give you a breakup of this 8,000 crores also. We brought down the certificate of deposit from 22,000 crores to 7,000 crores. That's also very comfortable now. So all kind of, issues with, the top 10 borrowers, concentration was 12.8%. It's only 4.3% now. So basically, again, we worked on, de-risking the balance sheet, both on the liabilities and asset side. And I think we've done that. Now, coming to this particular quarter, let me just say that our wholesale funded assets, basically wholesale loans, the funded side, it grew sequentially from 20,822 crores last quarter to 21,647 crores. So let me just say it's a sequential growth in wholesale loans. We always maintain that, while retail is our big mainstay, wholesale too is important to us. And if we find good quality credit, we will do it. And I'm happy to say that, it's been 3 years since the merger. The quality on the wholesale loans is simply excellent. We haven't had any significant, even a single account to talk about which is of any significance. On the including non-funded assets, our wholesale loans is now 45,000 crores. Now, another data point is that during the last 1 year, A and above rated exposure on that side is now grown from 74% to 79%. So broadly, that story on the wholesale side is fine. Now we'd like to give you a bit of a breakup as of this quarter end about what the total fund of the total funded and non-funded assets. Basically, of the total funded assets, what is the composition of a book? If you go to composition, basically home loans is 10%, low-range property is 14%, wheels is 8%, consumer loans is 13%, rural finance is 10%, commercial finance, basically business loans, small business working capital, business installment loans, those kind of stuff, that's 9%. And corporate and other loans is about 23%. So you can see that, we're now diversified over 10, 12 lines of businesses. No single line of business is more than 15%. So it's rather diversified. And even the one that's greater than 15% is corporate. But like I said, we're now feeling broadly comfortable on an incremental basis. The next point is basically, the infra is 7%. Now, next is about a dispersal. On dispersal, basically, a simple one-liner is that dispersal is back to pre-COVID levels, and we don't worry about that anymore. Next point is that, the retail book itself, this time we have segregated between two parts. What we used to call as retail until the last quarter, we try to do a bit of comparison with the system as such, and we find that a lot of this small entrepreneur loans and business loans and SME loans, usually the banking system calls it commercial finance. And we were calling it retail finance and wholesale. We were too blunt about our classification. So this time we have further segregated it. So we call the retail book as a retail book, and then the business finance we can now call commercial finance. So the breakup is that now our retail book is 75,500 crore and the commercial book is 10,500 crore. So together you can call it like 86,000 crores. Now I'd like to, our restructuring as a percentage of the book is 2.6%. And last point is about asset quality, and then I'd like to stop, and then I'd like to just make it open to questions. So maybe Sudhanshu can say if you maybe has a few inputs to give. Now, so back to the numbers on asset quality. Now, as far as we are concerned, we track our book by many criteria. We check what percentage of our checks when we present for clearing return. That's usually a very good indicator, because end of the day, later you have to, those customers flow into delinquent buckets if they bounce. So that is one indicator. We track how many customers bounce their checks as a percentage. We track that over the last 12 months, and we can say that it's almost like touched pre-COVID levels. It used to be like 12% earlier, it's now 12.1. Let me just say it's like touched almost fractionally, but it's almost as good as before. Number two, we check of the loans booked the previous month. In the subsequent month, what percentage of customers return their checks? Basically, it gives us an instant sense about how the quality of the incremental booking is as compared to what it was, say, 12 months ago or 18 months ago. So that number is literally at an all-time lows, and we feel really very good about that. It's like 8% something. Now, that is really good by any standards and going by any historical benchmarks we had. Number three, then we say that of the customers who return their checks, the third analysis we do is about how many of them, what is the collection percentage on those customers. Even those collection percentages, we track it by, bucket X, bucket 1, bucket 2, bucket 3, every bucket we track. And in every single bucket, we find that the recoveries actually kind of exceeded what was pre-COVID. So you can take that as a good data point and a good trend. The fourth thing we then check is of the customers who go into delinquent buckets, what is the recovery you get? I mean, assuming you've taken a provision against the customer base, but what about provision doesn't mean the customer doesn't owe us the money. So, the customer still owes us the money. So on that is what we call recovery. We don't call it collection, we call it recovery. So again, that's the fourth data point we track, and, numbers are looking pretty good. The fifth thing we track is vintage analysis. As to how is the portfolio booked 6 months ago behaving vis-a-vis what is booked 12 months ago vis-a-vis 18 months ago versus 24 months ago and so on. So again, that data point. So, we have done enough analysis on a portfolio and we studied day in, day out. And now we feel very confident to start guiding the credit loss numbers for the next year as well. Assuming, of course, there is no, fourth wave and, there's no crazy things happening. So all that is assumed. Now, assuming that things are going on as things are going on right now, we believe that next year we can now start guiding for credit loss of just 1.5%. And that's a huge statement from our point of view because we feel that we've never had it this low before. I want to just take you back a little in time that, when we used to do this business in Capital First, our credit loss used to be more like about 2.6 to 2.7% on a yield of about, say, 16.5, 16.6% or a little more than that. For this year, that is in 21-22, we had guided for credit loss of 2.5%, which I'd say it would be pretty good considering that wave 2 happened this particular year. And let me say we're broadly trending on that track. What was 2.5? We are now beginning. We then guided for 2%, thinking that we'll definitely achieve it, but now we're feeling a little more confident to guide for 1.5. So all in all, we're feeling pretty good about our asset quality. The other good thing from our point of view is that the wholesale book, we've had all of you have been quite concerned about our wholesale book issues and, what we call legacy or whatever. So those accounts, we've had a few infrastructure accounts, some road accounts, some toll road accounts, the Dewan Housing, Reliance Capital. We've had many of these issues. I'm happy to say that we now feel that most of those accounts are behind us. Maybe one or two accounts may be there, but they're not going to materially move the bank's P&L in any subsequent quarters. That we ever have to call out and say, oh my God, this account has happened, now we're going to post a loss. You won't hear those statements from us again. The other significant event that has happened in our lives is that the core operating profit. What I mean core, I mean net of not having any treasury or one-time kind of incomes, like core NII plus the core fees minus core OPEX. Now that number for the bank was literally at the time of merger used to be like 285 odd crores. Pre-merger was maybe 90 odd crores for the half year. So that number, what was 289 crores is now 650 crores plus. So therefore, we are pretty confident that even though the balance sheet just grew by 17% since the merger, the operating profit has grown by 100%. Now, if book grows 17, profit grows 100, you know that the incremental dynamics are really very powerful. And that, frankly, I'm not surprised because we know that if you do a business at 5.8, 5.9% NIM, value has to get created. It all comes back to credit loss. So we feel we're strong in credit loss. So once NIMs are strong, credit loss is good. We just believe that profit is only around the corner. It has to rise. So personally, of course, I've seen the cycle before. It starts with a loss and it comes to break even and then it starts getting to profit. So we've also come through that 2-3 stages in this bank for the last 3 years. But I'm feeling reasonably good about the whole thing. The last thing is about what happened on the telecom account. In this quarter, we had a 2,000 crore funded exposure, as all of you know. So that money is come back this quarter. We had decided to take an additional exposure of rupees 500 crores on them. It is part of an overall request made by the company, and we felt broadly comfortable considering that they were coming back and government was infusing equity and promoters infusing equity and all this stuff. So that's about what we have to give us the opening talk, and I just hope that helps. So thank you very much, friends, and thanks for being here today with us, and thanks for showing interest in our organization. You've been patient with us for many years, like 2-3 years now. We thank you for that, and I think it's our time to pay back. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, sir, just to take it forward, anything in terms of the cost to income, because across the board for all the private banks, we have seen a significant rise coming in terms of the OPEX, both on quarter as well as year on year. And particularly it's more related to customer acquisition, the retail assets, rollout, investments in digital and all. And we are also focusing on all these aspects. So finally, in terms of cost to income, how should we see, and what would be the guidance out there?
Should come down. As you know, we had a startup costs for these branches and ATMs and all that stuff. After all, we had to raise that kind of liabilities quickly. So we had to go through that cost structure. Then, then even our asset products are relatively higher cost of products. Not the recent one that we started, home loans, etc., but the other businesses of ours were relatively high cost. So our cost structure is relatively high. But I think that the cost to income from now on should begin to come down for us.
Sure. And secondly, in terms of how has been the slippage run rate overall? So we had seen a decline, but both in terms of the retail in particular, corporate, I think there is one account, but otherwise on retail, how has been the run rate and how would you guide for that? Yeah.
So maybe I'll take that. So we have seen an overall net slippage coming down by 25% as compared to the previous quarter. And on the retail front, and on the overall, as you mentioned, that there was a toll account which slipped into NPA during the current quarter, and that was already part of the identified stress asset pool, and hence, if we exclude that, that is the slippage has come off by 25%.
Okay, thank you.
Thank you. The next question is from the line of Maruk Ajania.
So before you come in, Maruk, I'd like to give a little more color on the slippage. The key point towards slippage is what happens in SMA. On the SMA front, we find that SMA as a percentage of the previous quarter, as a percentage of the book, in our core retail book, in our commercial book, in our wholesale book, we find in all three of them, it has come down to less than pre-COVID levels. So that gives us some indication that future slippages should be lesser. In the rural book, of course, it has increased compared to pre-COVID, but that's because of JLG book, and that has to play itself out.
Yeah, hi. So I just took just a clarification from your opening remarks. So now the exposure to the funded exposure to the telecom company would be 500 crores. Is that correct?
Correct.
Okay, and the non-funded would be?
1244.
Okay. And how do you view, what is the proportion of external benchmark rate linked loans?
External benchmark linked loan.
So we don't have that number specifically, which we have called out to the market. But on the corporate front, we have been pricing loans which are linked to MCLR as well as external benchmark link rates. And on the retail front, again, we have been pricing it based repo rate as per the regulatory guidelines.
Okay. Thanks a lot. Thank you.
Thanks, Farooq.
Thank you. The next question is from the line of Ishan Agarwal from Irvina Capital. Please go ahead.
Hello. Thank you for the opportunity. First of all, many congratulations for such a superlative performance on all fronts, and also on the large telecom account ambiguity being resolved. So the questions for the quarter are, firstly, if I see the NII for this quarter, just wanted to clarify that does this interest income include the interest income for this telecom account for the prior periods, or this is the core net interest income?
Yeah, maybe I'll answer that. Sudhanshu here. So the interest income for the quarter includes income on the telecom account for the prior period, and that is what we have also specifically called out when you see our NIM disclosure, that the normalized NIM for the quarter is 5.90%.
So what would be the quantum of the prior period income that has been added in the NIM in the NII?
Would be about 100 odd crores, but let me clarify that even in the previous year, in the same quarter, we had received interest on this telecom account on a cash basis as we were accounting it on realization. So it's sort of a comparable from an NI point of view on a year-on-year basis. And
no, actually, I was making a comparison on a quarter-on-quarter basis because on a quarter-on-quarter basis, I have seen a substantial jump in your NII.
Yes, quarter-on-quarter is not comparable. That's why we are calling it out also. If you notice the way we are calling out our NIM, if you go technically, if you compute the NII and divide by the average book, you'll find it 6.18.
Right.
But we are calling it as only a 5.9, if you notice.
Right.
We are never claiming our NIM for the quarter 6.18. We are claiming it's only 5.9.
Right. Yes.
Because we are subtracting what does not belong to this quarter, the prior period number. We subtract it because we don't want it to color the expectations of people, nor do we want it to show up as a NIM of this quarter.
Right.
Yeah,
so,
and this increase on a sequential basis is 14 basis points if we exclude that income.
Right. Secondly, when you guide for a credit cost of 1.5% for the total average asset book for FY23, will it be fair on my side to assume that the retail credit cost would be 1.8 to 1.85% and the blended retail plus wholesale would be 1.5%?
Could be, hopefully lesser.
Okay, great. And thirdly, if I look at the RBI data on debit cards and credit cards, our debit cards issued are up 9.22% in Q3 as compared to Q2, which is the highest increase for any universal bank in the country. However, the SAR value growth doesn't reflect that. Is it right to infer that average SAR ticket size is becoming smaller and hence more granular? And once this transition of outflow of large ticket size SAR is done with, SAR growth will again reflect the volume growth?
That would be correct.
Okay, great. And this point has been clarified. And what was the blended retail yield for this quarter?
You mean for the incremental booking or the stock? Or I mean,
for the retail book for this particular quarter.
We don't have the number offhand, but you can probably guess it about 15%.
So, So we have not been calling out that number, but you can assume that the incremental yield is about 14.5 to 15% on the retail book.
14.5 to 15%, and that I would can I assume that number would be slightly lower for 23-24 because our focus is now on home loans?
Yeah, I mean that's factored already, no? Because already doing good home loans.
Right.
You mean the prime home loans? We're already doing home loans.
Right.
But we're doing more of the prime home loans now. But yeah, it does bring down yields. But we also have other portfolio which is giving us a good yield, where we have a specialization in say 10 years. So they all mix up. But if just to be safe, you can go even 14.5. But I think leaves for a pretty good margin considering our cost of funds.
And again, the interest rates are expected to go up in the system in general, right? So I'm saying so next year it could be that the interest rates go up, right? And both the assets and liabilities sort of get reset. So sort of difficult to comment per se in terms of where these yields could sort of move on. But this could be some, I would say, a range bound. It could be range bound around 14 to 15%.
But even if it came down by a few basis points, frankly, it doesn't trouble us too much because of the fact that home loans is a good asset to have, and also because of the fact that the margins are still pretty strong.
Okay. And regarding the non-funded exposure to the telecom account, when does that bank guarantee get released? Is there a date for that bank guarantee to be released?
We hear from the market and from media and from whatever we hear from the company also that should come up for release. So we are hopeful.
Okay. Lastly, is the management confident of crossing the 6% mark on NIMs sooner?
I mean, it should inch up even from here, from these numbers, it should inch up, yes.
Okay. Thank you. And congratulations once again.
As you know, between 5.9 and 6 doesn't take too much to get there.
Okay. Thank you.
Thank you.
Thank you very much for those calls. Yeah.
The next question is from the line of Prakhar Agarwal from Edelweiss. Please go ahead.
Yeah, hi sir. Just a couple of data points to start with. What would be your gross slippage number, recovery and write-off for this quarter and subsequently last quarter as well?
That's what I thought Sudhanshu was calling out.
Yeah. So I had mentioned that the net slippage was about
That's why I needed gross number. That's why you mentioned about net slippage, which will have recovery and write-offs in place as well. I just wanted a gross slippage for the quarter.
Okay. So the gross slippage includes that one toll account which sort of came in during the quarter, which was about 248 crores. Excluding that, the gross slippage was about 1,200 odd crores.
1,200 crores. And any predominant segment from which this because consumer finance is seeing around 1,200 odd crores, any predominant segment that we are seeing this number coming from?
No, we find that it was basically JLG that we have noticed that among all our portfolios, it's almost like I said, I read out numbers to you earlier in the opening remarks, that things are almost heading back to the pre-COVID. I think JLG is the only one that still has, more amount of SMA by an order of magnitude.
Perfect. Just a second part in terms of telecom clarification there. So you said 500 crores of fund base and non-fund base of around 1244 crores. What is the outstanding provision that we are carrying on that as of now?
On what?
On telecom exposure, what is the provision that we are still carrying on?
We have no provision. We have released the entire provision.
Entire provision is released. Perfect.
Yes.
And then lastly on this credit card, so while it's too early to gauge a trend, but what would be your revolver percentage is that? And while we are reporting a loss in that particular aspect, in that particular book, it's largely to do with OPEX or anything to read into your credit losses into that segment?
No. Nothing to do with credit losses. In fact, the credit is behaving very well there. Anyways, largely to cross-sell to existing customers and all that. It's basically startup cost because the credit card by nature of the business is such that it's got a huge amount of technology expense and system expenses and setup cost for call centers and you name it. It's got all those expenses that come with it, reward points and all that. So basically that's how the credit card business works. So at this point of time, this is largely the book is not yet built up to scale, but the OPEX is still there. That's how any business starts, I guess. You start with the expense and income comes later. So our book is, I think, about 1,600 crores now.
Yeah.
And I think once that book scales up, we have no doubt in our mind we'll make lots of profits there.
And just to add, in terms of spends, we are seeing a very healthy increase in spends on credit cards. And in fact, this quarter, because of also the festive, because it was a festive season, we have seen a very healthy increase. And spends were up almost 50% as compared to the previous quarter.
And Praka, let me tell you, if you're not using our card, you're missing something. I don't want to know the name of your card you have in your pocket, but chances are that your APR is 42%. Your default charges are probably 48%. Probably you build lots of fees here and there, and maybe you're also given a fee waiver subject to spending X or Y. Ours is a very simple, straightforward card. We don't, take money from your pocket this way or that way. It's really free for life. If you spend, you spend. You get a good amount of reward points. If you go over the limit, we'll probably call you and tell you don't go over the limit. We'll have to bill you fees. It's a very honest, nice, good quality card you should have in your pocket. So please own one.
Okay, I'll try that, sir. Just one last clarification. In terms of consumer loans, what all is included in that? 1,600 crores of portfolio, 16,000 crores of portfolio, what all is included in that?
Yeah, I see you evading the question on credit cards, but nevertheless. So, on the consumer, it is largely personal loans to salaried people, even digital loans, consumer durables, and those kind of products.
Perfect. That answers it. And I'll try the credit card for sure.
Thank you for that. Appreciate it.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Congratulations on excellent performance, and sir, I can already see you doing cross-sell even during an analyst call, which is brilliant.
Of course.
Sir, my questions were two. One is on the growth of the liability side. The deposits, if you see quarter on quarter, retail deposits were flat, and when you say borrowings and legacy borrowings going off, are you going to replace them with CDs, or how is this traction going to happen? Is the first question. The second question was...
Hold. Just ask one question at a time. It'll be easy for us. So let me just answer that one. So yeah, basically see, after we dropped the rates, there were a number of customers who had simply moved money to us because we're paying 7% or 6%. So they just found it an easy way of managing their liquidity and so on. So a lot of those customers who were just, let me say some of those customers who withdrew their money, they got easily filled up by the new customers who came in even at the current rates. So that phenomenon's been playing out for the last 2 or 3 quarters. In any case, we never wanted more deposits for the last 2 or 3 quarters because of the fact that we were already running LCR of 170%. There was a huge amount of negative drag. So really, and also the refinance lines are available at cheaper rates, even cheaper than fixed deposit rates. Therefore, we were happy to manage a liquidity like that. So now that, like I said in the opening remark, if the book starts growing, we'll start growing this deposits again. It's not a problem. I told you the numbers earlier. We feel it's a lever we press and we take.
Okay, and would that be because you've already invested in the branches and you just need to kick in the operating leverage? Would that be a fair thing to say?
Absolutely. Because there's believe me or not, we have a really good brand. We may not be in the league of those big fours, but we are, let me just say, close in terms of the respect the brand enjoys among our customers. And really, I'm not doing a double sales pitch on you, so Vivek, but I'll just tell you that because our fee structures are really very fair, and there are lots of fee structures which we are not charging, like non-home bank charges, IMPS charges, then it's free, and SMS banking charges and digital banking charges. There are a lot of those things we don't. So people who bank with us are very few of them leave us. So we hope that. So therefore, we believe that customers are with us will stay. New customers keep coming. India's a large market. So that's what think about it. To say that, think about that the branch structure is there, deposit can come when we want it, no problem.
Okay, sir. The second thing was a remark that you made on the JLG book, which you said is still running very high. Have you seen any sequential improvements in that book, given the fact that the Omicron wave lockdown seems to have been, it seems to be slowing down?
Yes. Despite Omicron, we are seeing month on month for the last, I think, 3 months or so, our what we call the SMA, 0 to 89 buckets, we are finding that even for JLG, that number is coming down. So we are not like very bearish on JLG. Of course, numbers are much higher than the rest of the businesses. Slippage was more than other businesses. All that is true. But we feel it'll be okay. I mean, it's not like a crisis.
Thank you very much and good luck, sir.
Thank you very much, Vivek.
Thank you. The next question is from the line of Subrat from SBI Life Insurance. Please go ahead.
Hi, sir. Thanks for taking my question.
Hi, Subrat.
I know that you don't disclose how much is the BBB or below BBB numbers in the wholesale account, but if there is any color on that, it will help.
Well, we can share it. It's not a big deal. As we speak, we'll pull out the numbers.
And maybe if I can just start on that one. So on the wholesale, the book, as Mr. Vaidyanathan said earlier, that the book is very pristine, the new book which is getting sourced, and that's also getting reflected in our improvement in the rating mix. On an external rating basis, more than 75% of the book is rated A and above. And
79.
Actually, 79% is rated A and above. And based on internal rating, about 80% of the portfolio is rated A and above if we exclude the infrastructure book.
So we'll give you one more number since you asked for it. As Sudhanshu was speaking, I got hold of it. So A and above is 79%, and BBB and below is 21%, if that helps you.
Okay. And this includes wholesale and infra both?
This is
That's correct.
Yeah.
Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Yogesh Singhvi from Sky Investment. Please go ahead.
Good evening, Vaidyanathan, sir.
Good evening. Hi.
Actually, I have no question, just a sincere feedback. So numbers are all good, so there is no question left, and already you have answered the question. So, sir, actually, I just wanted to give a feedback. Since very last few quarters, I am seeing that you are publishing numbers on the weekend, sir. So any particular reason about that? Because normally banks or other companies, they declare results in the market hours.
Yeah, think about that. We just felt safer with regard to confidentiality and so on and so forth, saying that, look, these are, because the market closes.
Why I'm saying, sir, because normally bad results are published on the weekends and good results are published in the market hours. Okay. So that is one thing. So because our results are so good since many quarters, but we are publishing on the weekend.
Okay, we'll think a little about that.
Feedback from the shareholder side.
And even the two largest private banks have disclosed on a weekend only. However, we still take note of the suggestion.
We'll think a little deeper about that. Sometimes we feel that it's a little safer in terms of confidentiality because in the last few hours or before the results are announced, a lot of information flows back and forth between the key managements who have access to that information. So if that is done after Friday, after the books are closed, after markets are closed, it just feels a little safer. So that actually is the thing that goes on back of my mind. But anyway, we'll think a little deeper about that, maybe.
Thank you so much for listening to the suggestions, sir.
Thank you.
Congratulations once again. Thank you, sir.
Thanks very much. Yeah.
Thank you.
Thank you. The next question is from the line of MSJ Ashish Krishna from MSJ Capital. Please go ahead.
Sir, thank you so much for the opportunity and for the great set of numbers that you posted. My question is on the reverse merger with IDFC Limited. Is there anything that you can share currently and on when the timeline would be for the completion of the reverse merger?
Hard to say. I think whatever is there in public domain is already there, so I wouldn't like to add too much to it.
Thank you, sir. That would be it.
Thank you. The next question is from the line of Aditya Singhania from Enam Holding. Please go ahead.
Thank you. Congratulations on great results, Mr. Vaidyanathan. I just wanted to get a breakup of the provision line item and fee income, if possible. It would really help if you get that, in the presentation itself, but if you can share that on the call, that would be useful.
Yeah. So in terms of provisions, as we have...
No, fee income.
Yeah, he has asked for provisions.
Both actually.
Okay. Yeah. So in terms of provision, as we have mentioned in the presentation, that provision for the quarter was 392 odd crores. During the quarter, certain items to note is that we have released provision of rupees 487 crores on Vodafone. But at the same time, if you see that we have improved our PCR from 52% to 57%, and for that we had made certain additional provisions. We have also called out that we have made provisions of about 250 crores on legacy infrastructure and corporate accounts. And further into the presentation, if you see that PCR on the corporate book is now close to about 82-83%. Even on the infrastructure account, where if we exclude that one large toll account which has slipped into NPA in Q1, if we exclude that, because we expect no material economic loss there, hence we are calling out for the exclusion, then the provision cover on the infrastructure book is again 85%. So the moot point which we want to say is that the provision cover is quite healthy on the corporate and the infra book, barring that one large toll account which is at about 19% odd. And if we include technical write-offs and exclude this large toll account, the PCR cover is actually 75%. So that's broadly on provision.
Because the provision number usually seem gross of technical write-off. because, it has a direct bearing on provision. So that, if you take gross of technical write-off, that number moves up from 57 to 67.
Yeah, 67%.
And
I got the information in the presentation. What I was looking for is a breakup of the provision line item into loan loss provisions, any investment-related provisions, standard accounts, and any other items, if possible.
Loan loss, yes, sir.
So all are pertaining to, I would say, loan loss provisions are largely there during the quarter. And in terms of investment provisions, as we have said that we have released provision on the bonds, right, of Vodafone, which were in the form of investment. So that has given release in terms of investment provision.
So basically think of it, just to summarize, you might ask, listen, you release Vodafone, now where is the money? So let me answer the question. So supposing we say that Vodafone release was 487 crores. So we thought that, it's a good thing for us to use this opportunity to increase the provision coverage ratio and strengthen the balance sheet. So we increased the PCR from 53 to 57. That is net of technical write-off. I told you gross it would be 10% higher. So we used that to increasing provision coverage, and then we also provided for fresh movement of wholesale accounts to NPA, like the new toll account of 248 crores that moved in and so on. So that consumed about 250 crores. About 250 crores was there for PCR increase. So that's where that is there. So the money is there. We hope that as and when those clients pay back, and by the way, on both the toll accounts, we eventually expect to get the money back. And that money comes back, it will come back to the P&L. As of now, the balance sheet is more fortified, stronger, better PCR and all that.
So the total gross provision for loans is about 875 crores this quarter. There is nothing else in terms of other types of provisions. That's what I just wanted to clarify.
Yeah, largely it's a retail, it's the normal provision that comes to the retail book. And then, like I told you, the Vodafone account, I'm calling the name out because everybody knows the name anyway. So that release, we used it for, for wholesale accounts that slipped this quarter and for increasing the PCR. So that's the very simplest way we can reconcile it for you. So, like I said before, those two wholesale accounts, infrastructure accounts, we are actually hoping to get the money back. So today or tomorrow, hopefully the money comes back, and then hopefully it comes back to the P&L someday in life.
So I just wanted to clarify this in the context of the guidance you gave on credit costs. Was that for the current year or for the next year?
Next year.
1.5%.
1.5 next year.
Oh, okay. Got it. Thank you. All right. And just to break up on the fee income if possible.
So, as you mentioned that our fee is quite granular. So the total fee for the quarter was 744 crores, out of which 82% was retail fees, and about 35% of the fees was linked to loans which were disbursed during the quarter, and the rest is fees linked to your cash management, linked to your third-party products and so on. Then we also do toll business. Some fees we also do from credit cards. So it's quite a granular fee stream which we have.
Most of your peers actually give quite a detailed breakup of fees. So it would really help if you gave a breakup of both fees and provisions on a quarterly basis. It would just help, unnecessarily data questions being asked on the call as well.
No, thank you for that. We'll give more granular data on fee income next time on that.
Thank you, and congratulations once again.
Thank you. Thank you very much.
Thank you. The next question is from the line of Rohit Jain from Tara Capital. Please go ahead.
Yeah, hi, good evening. Sorry I missed a bit of the call, so if this question has already been asked, please excuse me. But just wanted to know, the improvement in NIM, was it driven by lowering of funding cost, or was it driven by increase in the lending yield?
No, we discussed before you came on the line that this included a certain amount that came because of prior period of the telecom account. The telecom account paid back interest this quarter, but we were accounting for it on a cash basis. So a portion of the money actually pertains to prior quarters. We report our NIM net of those prior period money.
So even net of that, I think it's 5.8%, which has improved sequentially, right?
Yeah, 5.9. Yeah, that 5.9 is all reals. There's no one type of.
That's what I wanted to know, that sequential improvement, even if one considers that 5.9, what is that driven by? Is it driven by lowering of funding costs, or is it driven by an improvement in lending yield?
It's a 10 basis points, hard to pick this or that, but let me just say that.
I'll tell you why I'm asking that question, because a lot of the growth has been driven by increase in your mortgage lending, and this, as you know, is pretty much a very competitive segment of the market. So one would have intuitively thought that that would have an adverse impact on the NIM, but the NIM has actually gone up. So that's what I'm trying to square in my mind as to what has driven the sequential improvement in the net interest margins.
No, your question is fair. I'm not dismissing it. I was trying to say that 10 basis was not an amount that we applied so much to. But our way of thinking about it is that it's not just home loan. We also have so many other businesses give us pretty strong yield. And as long as the mix keeps improving, 10 basis points there will increase. It will be mix. There's still an improvement in mix happening all the time. You want to say something?
So I think you are looking for some numbers. So I think in terms of yield, that yield has been broadly stable. If we compare it to the previous quarter, it came down on a blended basis by about 10 basis points, whereas the cost of funds came down by 20 basis points during the quarter.
Okay, perfect. And the second more structural question that I had, and I think I've asked this before also on earlier calls, is your bank is operating at a very high NIM of 5.9%, and in my history of tracking different banks, even the ones that have the best cost of funding, the NIMs generally have stabilized around the 4.5%, where you are in the sweet spot of risk versus return. So, is there not a risk that, right now, as I said earlier, we are in a great retail credit cycle and all of that is good, but how sustainable is a bank operating at a NBFC-like NIM of 5.96%?
Okay, now we think about it. First of all, our business model is becoming more and more like a mainstream bank as far as the incremental book disbursements are concerned. Like if we're doing new car loans, we're doing home loans and all that. So, but still, to your question about the margin, now think of any of the mainstream banks in the country today and remove the wholesale book from their books. Now, what do you think the NIM would be? It would be much higher, right? So,
the whole question is that there is a merit to having a diversified book. So I know, right now you are running a retail-heavy book, but that is what I'm coming to. That is that a sustainable business model?
Hold it. That's what I'm trying to explain to you. I think you jumped a little ahead of that. So I was just saying, think of a bank which has a relatively lower share of a wholesale funded credit. As you know, wholesale funded credit of top corporates go at really fine prices. So, we think that our book would have more of currently home loans is growing at 44% per annum. Last quarter was 47% growth. This quarter is 44% growth. So our home loan book, the prime home loan book, is a really big opportunity, and as I hope all of you will agree that there's no limit to how much that business can grow. So as that business begins to grow, as our new car loans begin to grow, I think there could be some sort of a tapering off on these numbers. But as things stand right now, the fact that we're guiding for credit loss of 1.5% next year, it must tell you that we're feeling pretty good about about asset quality. And let me tell you,
I'm not talking about the next 1 year. It's more of a medium-term question. So you said that there would be some tapering off.
Hold it. Let me add one more thing. You think about it. You think of a Muthoot or Manappuram. Okay, you may say it's gold loan. Nevertheless, we'll talk about that later. But then you could, or think of the very large Indian NBFC, which is there in this market right now. You could be lending at 16%. You could be having a NIM of 11%. If they go on and on for 10 years, maybe in the other case, other gold company, maybe 20 years, 30 years, 50 years. So basically, it is a specialization that companies have developed in their respective spaces. So it would be purely theoretical to say that high NIM could high credit loss. It's basically a specialization that we have built. So that's why I like to think about that. And actually, if you think of many of the lines of businesses we do, our credit loss is really very, very low. And even at 1.5, I hope you'll agree it's pretty low.
No, I understand that, but I really struggle to understand this. When you compare, let's say, yourself with a Muthoot, I mean, I know you just use it as an example. it's not exactly the right comparison because that's a monoline business where growth is determined by, whatever factor it is. And as you yourself said, you're becoming more and more a mainstream bank, and I guess that's the way forward as well. So, maybe the area that you're specializing in, that is very different from some of the other mainstream banks if your aspiration is to be more like a mainstream bank.
No, it is a mainstream bank, no? Because after we're doing corporate banking, we like it because, like I told you, 3 years have gone by, we've not had a single blow up on wholesale credit of a single loan given after merger. So we like that. Business will grow that also. We like mortgages, we'll grow that. We like new car loans, we'll grow that. We like the loan against property, we'll grow that. We do like loan against property, we'll grow that. So you see, the point is that you get all of these businesses are fantastic businesses. They've all been in India for 30, 40, 50 years. So, and forget even private sector banks like ours or other big boys, big players. Think of even state-owned banks, even smaller state-owned banks like an IOB or a UCO. They don't seem to have any problem in credit in any of these sectors. I mean, not had one for the last 30, 40 years. So therefore, these are, because India has we should not forget that in India, the whole ecosystem has very much become supportive for good credit because of 4 bureaus, because of data, because of analytics, because of cash flow evaluation, because of a number of factors. We won't have time to go through all that now. But the point is that the ecosystem, the guardrails in the country have become very, very strong. So we should not get purely theoretical about this. We should be more about having really good controls. And let me just say that we run this for 10 years. Even in our previous avatar, 10 years is not like a joke. It's not like a year or two flash in the pan. And for 10 years, we've never had a credit loss problem dealing with all these segments. So let me leave it at that. I think the debate can go on for a while. So let me just leave it at that. Maybe if you have a concern, maybe you can also introspect. We'll also introspect about that.
Okay, fair enough. Thanks a lot.
Thank you. The next question is from the line of Trimukh from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. We have few questions. One is, sir, if I see your credit card spend share, you are closer to 1% of the system credit spends, while you have just recently launched. So just wanted to check what would be your aspirational level over the next 2 to 3 years in this as a market share.
We haven't put out any specific number like that. We'll go with the flow. We don't want to start at the end in mind on this. We got to do it very carefully, build a good brand, build a good experience for customers, and build good credit quality and all that. And then whatever it comes, we'll go with the flow.
Understood. And so on your deposit, if you can share some more details, maybe, what is the share of top 20 depositors, or maybe what is the average ticket size in SA and TD? And is this like 100% sourced from branches, or do you also source DSA channels for deposit sourcing or any other non-branch sources?
So on deposits, we largely do sourcing through our own employees and also open accounts digitally, where it's a DIY process. A customer comes and opens an account. And so it's not through DSA, to answer specifically on that. And in terms of CASA, so that, as we mentioned, that has grown by 18% on a YOY basis. In fact, average CASA grew by 29%. And in that, the proportion of CA has increased at a faster pace at about 65% on a YOY basis. Of course, for us, CA relative to CASA is currently a smaller percentage, just about 15% of the total CASA. And we see ample opportunity of the faster growth sort of continuing in that segment. Does that answer your question?
No, so it does in part, but any comment on the ticket sizes here, maybe on SA or TD?
We have a relatively higher ticket. Let me say we are a slightly middle upper income-ish customer profile, so to say. So that probably gives a color, maybe about lakh and a half, or maybe 80,000 to a lakh when people open accounts with us. A little more than that.
Sure. Understood. And any color on the retail within TD? What would be the bulk TD and retail TD, or if it is there? So I think we have already given that side. So, okay, so that is good. So I think it is there, right, in your presentation, retail deposit and wholesale deposit, including CD.
Yeah, deposit numbers are mentioned on slide 50 of the presentation. And in terms of TD book, we have given that CASA plus TD less than 5 crores. That book is as granular in the total deposit base, and that ratio stands at greater than 85%.
Sure, understood. And sir, I had missed your initial comment wherein you said that the telco exposure was fully repaid, the bond exposure, and you have created a recent exposure of 500 crores. You also mentioned something that, the color of that exposure, as in, why do you need to not have any provisions there? So can you just repeat that? Why don't you want to continue the provisions? Despite having some exposure there?
See, as part of this process of, the company expected the banking system to come forward, and that's just because I think every company would have lines of credit going with the banking system. So their representation was that, listen, end of the day, government is taking stake in our company, and they have, and the promoters are putting in equity, and we'll be a good up and running, proper, good quality going concern. So we are a large group. End of the day, and they are a large group with so many businesses across so many. It's not, we didn't think it appropriate that, we want to pull the plug completely on them. After all, we want to respect that institution. And we felt that, in its earlier avatar, of course, we won't take any credit. But in the new avatar with the government equity, promoter equity, all that coming through, all that, we felt comfortable participating in the process. And then once we're giving this fresh facility, we felt we really don't need to take any more provisions on that.
Understood. And lastly, on two data keeping questions, if you have the ECLGS outstanding for your bank as of third quarter, and have you seen any slippages from that book?
So the ECLGS outstanding book is about 1,500 odd crores. And we have not seen any significant credit deterioration there.
Sure. And the last question, sir, on your stock of provisions. So I see your specific provisions is somewhere around 2,500 crore. Is it safe to, the provisions that you carry on your stressed but not NPA watch list kind of a thing, 800 crores, that is over and above that, right? Or what is the stock of non-PCR provisions as on December?
I think the number is there, 1,080 crores or something like that. That book has actually really come down, 1,083 crores. 1,083 crores, on which we have a provision of 877 crores. This is not.
Sir, I'm so sorry to interrupt. May I please request you to rejoin the queue for your follow-up, as we have people waiting for turn?
Yeah. So
Thank you.
Yeah. Okay, short answer is that out of 1,083 of identified stress account, provisions is 877, PCR is 81%. Okay, let's move.
Thank you. We take the last question from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the opportunity. Quick couple of questions. One is clarification on the credit quality. 487 crores of provisions for the telecom account which were reversed, how much of it was in the current quarter?
This quarter, everything.
Okay, so adjusted for that, then if I were to understand our P&L provisions would have been around 879 crores, 391 plus 487, right?
No. We need not, there was nothing pressing for us to really take the PCR from 53% to 57%. So this was an amount that kind of came to us in this quarter, so we actually thought that why not strengthen the balance sheet to take it. So you can't really assume that if this had not come, then probably PCR would have been lesser, but the bank would have still been quite profitable.
So let's then, trying to understand better, let's then assume, had it not done and you had kept the PCR same, what would have been the credit cost? Because I want to do like-to-like comparison, have a sense of how the cost is evolving. So two things have happened. Had both not happened, what would have been the credit cost?
No, it's not so easy to do the quick counterfactual without a pen and paper like this, because even the wholesale accounts that we've taken provisions on the wholesale account, some proactive provisions we've taken, the 250 crores we talked about. So theoretically, they could also have a counterfactual. So let me just say that the simple way of explaining this is what I told you earlier, that 250 crores is for corporate accounts that we have taken this quarter. Rest we've increased the PCR from 53 to 57, and you got to just go with this number at this stage.
Okay, I'll just repeat so that 250 crores is for some corporate additional provisioning.
Yes.
And PCR increased from 53 to 57, these two. And what was the last, sir?
That's it. So then other than that...
Okay, fine. These two. And took additional provisions, and the release came from the telecom account 487.
Roughly you can think like 487 came and then kind of got used up in this. Like I said, we wanted to strengthen the balance sheet. We wanted to, let me put it very simply, that we want to use the opportunity to strengthen the balance sheet. And we did. So tomorrow, for example, if you provided for that particular infrastructure account, which the 248 crore account where we've taken significant provisions. Now let me say that, some quarters go by and the money comes back. It comes back, and this money can still come back to the P&L. But as of today, you feel safer, we feel safer, everybody feels safer that, look, there's no much more hits yet to come. You see, one of the big issues that people have always had with our bank for the last 3 years has been, look, how much more to come? I mean, people are almost short of using the word, said, listen, folks, how long can this legacy wholesale account story go on? So yeah, I mean, we used the opportunity, we took it out, and we believe that no major legacy account issue is pending in front of us.
Sure. That's very helpful, sir. And sir, a couple of data keeping questions. One is, microfinance book, if you can give me the Part 30 as of December and as of September, so that I can get a sense of how the microfinance book has evolved.
I don't think they have the number offhand, but like I told you that that had a relatively more delinquency than the rest of the book by an order of magnitude more delinquent. But like another member asked earlier, participant saying that how's the trend looking like? That trend is also improving every month for the last 3 months. But still, the short answer is it is more delinquent.
Noted. And restructured book, what would be the absolute amount of restructured book, OTR 1 to MSME restructuring, absolute amount as of 31st December?
2.6% of the book, we said.
Okay. Thank you, sir, and have a nice weekend.
Yeah.
Thank you very much. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Kunal Shah for closing comments.
No, before Kunal comes in the line. So first of all, I want to just make a closing comment. So I'd like to just say that thank you, every one of you who've been with us for the last 3 years and tracking us so closely. We've been through a lot, merger issues, legacy, this, that, wholesale account, infrastructure account, COVID. We've been through a lot. But the good thing is that I must safely say that the balance sheet is now pretty strong, not pretty strong, very, very strong. The key thing is that I think one conversation got lost in the whole story is the operating profit. I think that operating profit reaching this sort of order of magnitude is a very big event. And if you now start taking normalized credit loss, which comes in a normal book of 1,20,000 crores, that we can begin to say that operating profit is higher than a normalized credit loss. And by that logic, barring some really unforeseen circumstances, which I hope not, our bank should not have to, ever post a loss again, hopefully. So that's what I'd say. And therefore, I call it a very inflection moment. And really, we've covered a lot of ground. So now let me just say that people who believe that this story is set for a significant change, either you will believe us today, or you believe us 2 quarters, or you believe us 4 quarters from now, but believe you will. Because that's how I think the game is changing now. So thanks so much do watch this space for the next 2-3 quarters and you'll get more convinced. Thank you.
Yeah, thanks a lot, sir, for such I think patiently answering all the questions and also giving the insights around the business strategy as well as the future, and all the best. And thank you all the participants for being there on the call. Have a nice weekend. Thank you.
Thank you very much. On behalf of ICICI Securities, that concludes this conference. Thank you all for joining. You may now disconnect your line.